All right, welcome back to Learning Objective 2. In this video, we will be describing the major characteristics of bonds. What are long-term liabilities? Long-term liabilities are obligations that are expected to be paid for more than 1 year and are often in the form of bonds or long-term notes. Now, what are bonds? Bonds are a form of interest-bearing notes payable issued by a corporation or university and government agencies, right? Bonds, like common stock, are sold in small denominations. When a corporation issues bonds, it is borrowing money. The person who buys the bond, that is the bondholder, is investing in bonds. Bonds may have different features, okay? So we have the secured bond. Secure bonds have specific assets of the issuer pledged as collateral for the bonds. And then unsecured bonds are issued against the general credit of the borrower. If the person's credit is good, then you buy. Convertible bonds, this can be converted into common stock at the bondholder's option. Okay, the conversion often gives bondholder an opportunity to benefit if the market price of the common stock increases substantially. So for the issuer, the bond sells at a higher price and pay a lower rate of interest compare than comparable debt securities that do not have a conversion option. What are callable bonds? Can be retired by the issuing company at a stated dollar amount before or prior to maturity. Now, what is a bond certificate? A bond certificate is issued to the investors to provide evidence of the investor's claim against the company. The information the certificate provides include: one, the face value. And when we say the face value, that is the amount of principal due at maturity. What is maturity date? Date that the final payment is due to the investor from the issuing company. And then lastly, we have contractual interest rate. Contractual interest rate, that is the stated rate used to determine the amount of cash interest the borrower pays and the investor receives. The contractual interest rate is generally stated at the annual rate, while the interest rate is usually paid semi-annually. So you want to take note of that. So this is an example of what our bond certificate looks like. The issuer of the bond, that's the person borrowing money, the maturity date. We have the fair market value, the contractual rate, and the like. So this is what it looks like. Determining the market price of bonds. The purchaser of a bond needs to determine how much to pay for a particular bond. So its current market rate value of a bond is a function of three major factors. So we have the dollar amount to be received, the length of time until the amounts are received, the market rate of the interest, right? So the market rate or the market interest rate is the rate investors demand for loaning the funds. The process of finding the present value is referred to as discounting the future amount. All right, determining the price of a bond. So we're going to do this illustration together. So assume that Accor Police Company on January 1, 2022 issues 100,000 of 9% bonds due in 5 years with interest payable annually at the year end. Okay, so here we have our present value. We want to know what the present value of this 100,000 will be in 5 years. Now, if we're able to do the extra credit opportunity last week, then this will not be difficult for you. So we're going to find out using our present value table. You can find this table on G8, right, of Appendix G. Okay, so we have our present value table of 1, and because this is just a one-time receipt thing, we are using the present value of 1, that is table 3. Now, if you look under, you go through 5 years, that's on that period, you get to 5. And then under the percentage, you go all the way to 9%. You see that we have 0.64993. When you multiply that amount by your 100,000, it's going to give you 64,993. Now, for the present value of the 9,000 received annually, and so because this is an annuity, something that you receive every single year for the next 5 years, we will be using table 4, okay, which is the present value of annuity of 1, because it's an annuity because it's received continually the same amount for the next 5 years. Also, we go to under the end payments, you go to year 5, and all through you trace all the way to 9%. There you have 3.88965. If you multiply that by 9,000, you're gonna get 35,007. Okay. So the market price of our bonds is what? 100,000. So what is the present value of that 100,000? Is 64,993. Okay, included with the interest, our value of everything is still going to be 100,000. All right, so indicate whether each of the following statement is true or false. Mortgage bonds and sinking funds are both examples of secured budget. True. Unsecured bonds are also known as debentures. True. The contractual interest rate is the rate investors demand for loaning the funds. That's false. The face value is the amount of principal the issuing company must pay at maturity dates. Yes. The market price of a bond is equal to the maturity value. That's not true. Okay. All right, so that brings us to the end of that learning modules. I'll see you in learning objective 3, where we explain how to account for bond transaction. See you then.